In this video, I will show you the 7 best ways you can invest your SRS money, from the lowest risk options for conservative investors to the higher risk, higher reward options for those who can take on more volatility risks. So first up, government bonds. This is definitely the lowest risk option that you can find, since it is backed by the full faith and credit of the Singapore government and has the strongest AAA credit rating from international credit rating agencies. But of course, you can't expect high returns from here lah. Now, in case you are not familiar, there are 3 types of Singapore government bonds. The first one is the Singapore Savings Bond, or SSB for short. It has a tenure of up to 10 years, and the best part is that you can redeem it anytime with just 1 month's notice. So it's perfect if you want flexibility. Then there are the Treasury Bills, also known as T-bills. These are short-term instruments that last for just 6 to 12 months. They can be great if you are simply parking your cash for the near term and want something safe with a fixed return. And finally, there's the Singapore Government Securities, or SGS. These are longer term bonds that typically range from 2 to 50 years. Investors usually buy them when they want to lock in a stable yield for the long haul. Though right now, all of them are yielding around 1.3% to 2% per year, which is kind of sibei low. But that's also understandable because interest rates have been dropping like grapes since last year.
They're raining and drop like grapes, no? Can drop. I can feel it.
So unless you have a very specific reason to park your money here, like maybe you are ultra conservative or just waiting for better opportunities, I would probably look elsewhere for a higher return. Which then brings us to cash management accounts. If you still want something low risk, but don't want to settle for the tiny yields from government bonds, this could be a nice middle ground. These days, you can find cash management accounts on practically every robo-advisor. For example, StashAway offers 3 main options: Simple Guaranteed, where the returns are fixed, Simple and Simple Plus, where the returns are projected, meaning these are just the expected returns, and the real returns may be slightly different depending on market conditions and how the underlying funds perform. Similarly, Syfe has its Cash Plus Flexi portfolio, and Endowment, on the other hand, offers a full range from Cash Smart Secure all the way to the Ultra portfolio. But overall, the cash management portfolios are currently offering projected yields of around 1.6% to 2.7% per year, depending on which one you choose. Now, the reason they can offer higher yields than government bonds is because they're investing the money into short-term, high-quality instruments like money market funds and short-duration bond funds. In other words, they are designed to squeeze out a bit more returns without taking on too much additional risk. But what's the catch? There's always a catch one. Actually, there are 2. The first is that even though these accounts are low risk, they are still investments, not bank deposits. So when markets turn volatile, they can experience temporary drawdowns. For example, back in 2022, when the Fed was aggressively hiking interest rates, both Endowment's Cash Smart Enhanced and Cash Smart Ultra portfolios saw short-term losses. That said, if you can hold on long enough, it's usually not a big issue, as the portfolios tend to recover once markets stabilize and eventually go back to delivering positive returns. The second catch is that yields have been trending down. So if you're using the flexi type portfolios, you can expect that the returns will gradually decline over time. Next, if you're okay with taking a bit more risk for potentially higher returns, you can check out the RoboAdvisor income portfolios, such as Syfe Income Plus, StashAway Income Investing. While cash management accounts focus on short-term stability, Robo income portfolios are designed to generate regular payouts and higher long-term returns. And how high of a return are we talking about? Currently, most of them are offering payouts in the range of about 4.8% to 6.5% per year. That's easily 3% higher than what you would get from a typical cash management account. And of course, the volatility risk is higher as well lah. There's usually an option to automatically invest the payouts and activate the magic of compounding. Next, moving away from robo-advisors, we have endowment plans. And before you be like, but stocks and ETFs give higher returns, and endowment plans come with higher fees and lower returns. Report Kelvin to MAS for talking about endowment plans Just hear me out. While it's true that stocks and ETFs can potentially deliver higher returns, some people just prefer stability. They would rather have something that offers guaranteed payouts, capital protection, and maybe even a bit of insurance coverage, instead of watching their portfolio swing up and down with every market headline. And for those people, endowment plans may actually be a good fit. So typically how an endowment plan works is that you can either pay a single premium upfront or make regular payments over a few years. The insurer then pools your money and invests in a mix of relatively safe assets, things like bonds, fixed income instruments, and other low volatility instruments. And over time, the plan grows in value through two main components, the guaranteed benefits and the non-guaranteed benefits. The guaranteed portion is what the insurer promises to pay you no matter what, as long as you hold the policy to maturity and keep up with the required payments. On top of that, you may also receive non-guaranteed bonuses, but these are really just projections and not promises. Ultimately, your actual returns will depend on how well the insurance participating fund performs. If the investments do well, then congrats lor, you could earn more. But if they don't, well, you will earn less lor. But at the very least, you will still get back your guaranteed cash value. According to the data compiled by Keith from Investment Modes, the long-term illustrated returns for endowment plans typically range between 3 to 4% per year. So you can't expect anything fantastic, but for low-risk investment, that's pretty reasonable. However, there's an important catch. Endowment plans are not meant for early withdrawals. If you surrender your plan too soon, then you will likely get back less than what you have paid in because of upfront costs and surrender penalties. That's why these plans are best suited for people who want disciplined savings, predictable returns, and a layer of protection built in. Depending on your needs, there are also short-term and long-term options to choose from. Short-term endowment plans like DBS Savvy Endowments 20 or Great SP usually last for 2 to 4 years and are ideal for conservative investors who want to lock in a fixed rate over a short horizon for their short-term needs. On the other hand, long-term plans such as AIA Smart Flexi Rewards can run from 15 to 30 years or more, making them suitable for retirement planning, children's education, or other long-term goals. So yes, endowment plans aren't the most exciting investment for SRS, but they do serve a purpose for people who value stability over high returns. But if you are the type who doesn't mind a bit of volatility and you want the potential for much higher returns, then it's time to move on to the next section, stocks, or more specifically, stocks that are listed on the SGX. But even so, there's still a wide range of Singapore-listed counters for you to choose from, everything from banks, REITs, and blue-chip companies. However, there are two things to take note of. First, corporate actions such as rights issues or dividends can be a bit more mafan to handle. That's because if a company issues rights, you might need to top up your SRS account to subscribe, or else you will get diluted. And that can be tricky if you have already hit your yearly SRS contribution limit. Second, because SGX stocks still trade in bought lots of 100 shares, you won't be able to invest your SRS funds as efficiently as you might in fractional share platforms. So depending on your stock choices, you might end up with some idle cash sitting around. Nevertheless, if you want to invest your SRS money directly into Singapore stocks, the two cheapest brokers that let you do so are POEMS Cash Plus and FSMOne. POEMS charges a 0.08% commission, while FSMOne charges a flat $8.80 per trade. This means if you are investing below $11,000, POEMS will be cheaper. But once you go above $11,000, FSMOne becomes the better deal. The good news is that both platforms don't charge any platform or dividend handling fee, so that's definitely a plus. Next up, we have ETFs and unit trusts. In many ways, this is the most flexible and beginner-friendly way to invest your SRS funds. First, you get to diversify your portfolio easily without having to pick individual stocks. Instead of trying to guess which company will outperform, you are investing in hundreds or even thousands of them at once. Basically, you won't pick the wrong stock if you pick all of them. Second, the entry cost is much lower. You can invest with as little as $1 for ETFs or $100 for unit trusts, which means you'll be able to use your SRS capital a lot more efficiently. Third, ETFs and unit trusts are much easier to manage. You don't have to deal with massive corporate events like rights issues or bonus shares, so you will never have to worry about missing deadlines or topping up your SRS account just to avoid share dilution. Now, there are plenty of ETFs and unit trusts to choose from, but most investors usually focus on three main markets. First up, Singapore. Out of the many ETFs that track the Singapore market, the two most common ones are the SPDR STI ETF and the Nikko AM STI ETF. Though, for some reason, Nikko AM recently decided to rename themselves to Amoa Singapore. Anyway, both ETFs track the top 30 companies in Singapore, giving you broad exposure to the local market. In terms of trading costs, POEMS charges a 0.08% commission, while FSMOne charges a flat $3.80 per trade. And correct me if I'm wrong, FSMOne's 0% regular savings plan doesn't apply to SRS investments, only to cash ones. So based on the math, the break-even point is around $4,750. Below that, POEMS is cheaper. Above that, FSMOne becomes more cost-effective. Next, we move to the US market, where many investors prefer to invest in the S&P 500, an index that tracks the 500 largest US companies. Historically, the S&P 500 has returned about 10% per year on average over the long term. But of course, that's just historical data lah. No one can guarantee you will get the same results in the future. If you want to invest your SRS funds into the US market, the cheapest method will be either through Harmony Prime USA Fund, available via POEMS or Endowment, or through IWV ETF using StashAway's ETF Explorer. Between the three platforms, StashAway generally offers the lowest overall fees over the long term, with POEMS coming in a close second. And if you would like to diversify globally, you can consider a global ETF. Historically, global markets have returned around 9% a year over the long run, slightly lower than the US, but with more balanced exposure across regions. For this, you can check out the Harmony MSCI World Fund, again available on POEMS or Endowment, or the Isaac ETF through StashAway's ETF Explorer. And again, StashAway tends to be the most cost efficient, followed closely by POEMS. Then, if you want to explore even more niche sectors or themes, StashAway ETF Explorer also gives you access to specialized ETFs like QQQ for US tech, gold ETFs for inflation hedging, or sector-focused ones covering China, semiconductors, or even blockchain companies. But just a word of caution, many of these thematic ETFs tend to be a lot more concentrated and volatile, since they are focused on specific industries or regions. So unless you really know what you are investing in, it's better to keep this as a small satellite position rather than your core SRS holdings. Last but not least, if you prefer a hands-off approach where someone, or in this case something, does all the heavy lifting for you, then RoboAdvisors might be your best friend. Robo portfolios are basically automated, diversified investment portfolios that are built and managed by algorithms. You don't have to worry about what to buy, when to rebalance, or how to diversify. All you need to do is pick your risk level, deposit the amounts you want to invest, and think the Robo takes care of everything for you. The main Robo portfolios that support SRS investing are Safe Equity 100, StashAway General Investing, and Endowment's flagship portfolios. Each platform takes a slightly different approach to managing your money. So it's practically impossible to say which RoboAdvisor is the best, because each one has its own philosophy, strategy, and strengths. But what really matters is choosing one that fits your comfort level, whether you want high growth, steady income, or a balanced mix of both. When it comes to fees, all three are relatively affordable. StashAway charges around 0.3% to 0.8% a year, depending on how much you invest. Safe charges between 0.25% and 0.65%, while Endowment charges around 0.4%. What's nice about Robo portfolios is that they are constantly managed and rebalanced behind the scenes. So if markets move or certain assets grow too big, the system will automatically adjust your allocation to maintain your target risk level. So those were some of the best ways you can invest your SRS funds. If you need to sign up to any of them, you can use my links down below, some of which have exclusive promos, like the Endowment one here, which gives a much higher $50 off for 6 months instead of the usual $20. Anyway, hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.